Hello, and welcome back to the channel. I'm Algabot, your guide to the world of automated trading on MetaTrader 5. Today we're breaking down a fascinating pure price action expert advisor called Fvg Inversion Reversal. There are no moving averages here, no oscillators, no lagging indicators of any kind, just raw candle geometry. In this video, you'll learn how this strategy spots a fair value gap, patiently waits for that gap to fail, and then trades the reversal when price comes back to retest the flipped zone. It's a counter-trend reversal approach rooted in smart money concepts. Let's dive straight in and see exactly how it works. So what exactly does this expert advisor do? At its heart, Fvg Inversion Reversal is a counter-trend reversal strategy that lives and breathes one single concept: the inversion of a fair value gap. A fair value gap, sometimes called an imbalance, appears when a fast middle candle leaves a small untraded void in the price. For a bullish gap, the high of the first candle sits below the low of the third candle, and for a bearish gap, it's the mirror image. Many traders treat these gaps as zones that should hold and offer support or resistance. This strategy does the opposite. It waits for the gap to fail. When price closes decisively through a fresh gap, that imbalance is invalidated and effectively flips or inverts. A broken bullish gap becomes fresh supply, and a broken bearish gap becomes fresh demand. The very first retest of that inverted void becomes a high-probability reversal entry against the side that just failed. Because there are no indicators involved, every decision the strategy makes is built from raw highs, lows, and closes. The only average anywhere in the code is a plain mean candle range, and that's used purely to scale the minimum gap size to current market volatility. That's candle geometry, not a technical indicator. This expert advisor was tuned with foreign exchange majors and gold in mind, on time frames from the 15-minute up to the 1-hour chart. Although the logic itself is locked to no particular time frame and runs on whatever chart you attach it to. Who is it suited for? Educationally speaking, this is a strategy for traders who are curious about price action and smart money concepts, who appreciate clean, mechanical rules, and who want to study how failed structures can flip into reversal opportunities. Remember, this is for educational purposes only and is not financial advice. Let's walk through the exact logic, step by step. The strategy acts once per freshly closed bar, never on incomplete candles. First, it measures volatility by averaging the candle range over the recent look-back window, 20 bars by default. It multiplies that average by the minimum gap factor to set a floor on how large a gap must be to count. This keeps the strategy from reacting to tiny, meaningless gaps. Next, the EA detects a fresh fair value gap from the last 3 closed bars. For a bullish gap, the oldest candle's high must sit below the newest candle's low. The middle candle must be a real upthrust closing above its open, and the gap must clear that minimum size. The bearish case is the exact mirror. When found, the gap is armed and the strategy enters a waiting state. Now comes the inversion. For a bullish gap, the strategy watches for a candle to close below the bottom edge of the gap. That close invalidates the gap and flips it into an inverted supply zone, a potential sell setup. For a bearish gap, it watches for a close above the top edge, flipping it into an inverted demand zone, a potential buy setup. Each gap is given a limited window to invert. If it never does, the EA simply drops it and moves on. Once a zone is inverted, the EA looks for the first retest. For a sell, price must rally back up into the supply zone, with the bars high reaching the lower edge, but then close back under the top of the zone. That failed push higher triggers the reversal short. For a buy, price must dip back down into the demand zone, with the bars low reaching the upper edge, but then close back above the base of the zone, triggering the reversal long. The inverted zone also has an expiry, so if no retest arrives in time, the setup is discarded. When an entry fires, risk is defined precisely. For a short, the stop loss sits just above the zone, buffered by a fraction of the zone height. For a long, the stop sits just below. The take profit is then placed at a fixed multiple of that risk, 2-to-1 by default. The strategy holds only one position at a time per magic number, keeping things clean and disciplined. Let's read through the code as it appears in MetaEditor. At the top, we have the input parameters. MinGapFactor, set to 0.2, controls how large a gap must be relative to the average candle range, so raising it demands bigger, more significant gaps and produces fewer signals. Range loopback, 20 bars, sets how many candles feed that volatility average. Fvg expiry and retest expiry are patience dials. The first is how many bars a fresh gap may wait to be broken, and the second is how many bars an inverted zone waits for its retest before it's discarded. Shorten them, and the strategy becomes stricter about timing. Risk-reward, set to 2, is the fixed reward-to-risk multiple that places the take-profit. ZoneBufferPct, 0.15, pads the stop-loss as a fraction of the zone's height, giving the stop a little breathing room beyond the gap. And lots is simply the fixed position size. Now the signal logic. This block fires a sell. It first checks that the bullish gap is in state 2, meaning it has already inverted into a supply zone, and that at least one bar has passed since inversion. Then it confirms the retest. The last bar's high reached up into the zone's lower edge, but its close came back under the top edge. That's the failed push. The entry price is read from the current bid. The code measures the zone height, places the stop-loss just above the top of the zone plus the buffer, and computes the risk as the distance from entry to stop. As long as that risk is positive, the take-profit is set at entry minus the reward-to-risk multiple times the risk, and the order is sent. The buy side is the exact mirror, using the ask price and the inverted demand zone. Let's walk through this illustration to see both a long and a short trade in action. On the left, price drops sharply, and that fast move down leaves a bearish fair value gap, a small untraded void between candles. Watch what happens next. Instead of holding, price closes back above the top of that gap, which invalidates it and flips it into an inverted demand zone, shaded green here. The strategy is now waiting for a retest. On the fifth candle, price dips back down into that green zone. The low reaches up to the edge, but the candle closes back above the base. That's the failed break, and the buy entry triggers near 1.0852. From there, price climbs higher, and by the seventh candle it reaches our take-profit target, locking in the planned 2-to-1 reward on the long. Now watch the right side of the chart. Price rallies strongly, and this time the fast move up leaves a bullish fair value gap behind it. But the rally fails. Price closes back below the bottom of that gap, inverting it into an inverted supply zone, shaded red. The strategy waits again for the retest. On the 11th candle, price rallies back up into the red zone. The high pushes into it, but the candle closes back under the top edge. That failed push higher triggers the sell entry near 1.0879. Price then rolls over and falls, reaching the take-profit target a couple of candles later. Notice the symmetry. In both cases, the strategy waited for a gap to fail, let it flip, and traded the very first retest against the side that got trapped. The stop always sits just beyond the zone, and the target is a fixed multiple of that risk. This is an illustration for educational purposes only, and that brings us to the end. Today we explored Fvg Inversion Reversal, a pure price action expert advisor that detects fair value gaps, waits for them to fail, and trades the first retest of the flipped, inverted zone, selling broken bullish gaps and buying broken bearish gaps with tightly defined risk and fixed reward targets. We walked through the logic, read the MQL5 code together, and visualized both a long and a short trade on the chart. Remember, everything in this video is for educational purposes only and is not financial advice. If you found this helpful, please hit that like button, subscribe for more MetaTrader 5 strategy breakdowns, and drop a comment telling me which strategy you'd like to see next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.